Welcome to the RGLT Economics. Today, let's revisit the downfall of Credit Suisse. We know that a deal has been reached for UBS to take over Credit Suisse with a lot of aids and guarantees from the Swiss government and central bank. That's not the topic today. What's more interesting is the bail-in that took place with some of the bondholders of the riskiest bonds issued by Credit Suisse, the so-called additional Tier 1. Those are written down to zero, 16 billion, I think, is something that is very interesting. So in today's podcast, I will discuss it. First, I'll talk about the situation, and then I'll discuss what are the reasons behind this write-down, and finally, my take on what could happen next. So first, the situation is very interesting. It's strange, right? Because under the so-called Basel III rules, it's clearly stated that common equity Tier 1 capital, right? So basically, the shareholders, they are the ones that will be bailed in. The bail-in funds will come from first. In other words, it's always debt above equity, right? When a company is liquidated, usually it's always that the funds will pay the creditors first, and whatever is left is distributed among the equity holders, the shareholders. But now the Credit Suisse shareholders of Credit Suisse are receiving maybe pennies on the dollar, but still they're receiving shares of UBS. In other words, they are not completely written off. But at the same time, we know that the additional Tier 1 capital is completely written off. And that is a very curious situation. And this is, in my view, completely abnormal. And I think it's against the Basel III rules. I don't know exactly why this happened. Right. So basically, in terms of bail-in, there is this liability cascade, and you can find this liability cascade, especially that applies in Europe and in particular in Switzerland. I have it in front of me, and number one is common equity Tier 1 capital. Number two is additional Tier 1 capital, and then you have Tier 2 capital and all the unsecured loans. And then there are structured loans, and finally the deposits. And those that are exempted from bail-ins are secured loans, loans secured by assets, and deposits under the guarantee scheme of 100,000 euros. That's basically what the Basel III rule stipulates. Now we know that when banks fail, the story in Europe, in Southern Europe, is that they don't really care whether you have they don't really care about the deposit guarantee scheme, and it's not surprising that this time they don't really care about the liability cascade either. So, well, that's the situation. That's why it's so curious. Why do I think this is happening like as is? Two reasons, I think. One, Switzerland explicitly states that it follows the so-called no one worse off principle. In other words, a deal could be considered, could be approved if it is no one is worse off under this rule, under this deal, than an immediate liquidation of the bank. In other words, if the AT1 holders will be completely written off if the bank is immediately liquidated, then they are not worse off if they are written off, but in a different deal, right? So, but I still think this is abnormal, because always in business it is debt above equity. Why is it that equity holders are not shareholders are not written down, but the debt holders are first? This is very strange, and so that's the number one reason, that no one is worse off in this way compared to an immediate liquidation of the bank. Number two is that we should look at who are the holders of these, major holders of these AT1 bonds, right? I would not be surprised that there are some people that they don't want to get paid, that they don't want to pay. So and also, who are the equity shareholders? We know that major shareholders include the Saudi National Bank, but could also be some others that are quite crucial, and I think that's probably the reason behind it, that they are bending the rules. There must be some reason. So that's the reason why I think this curious situation has taken place. And finally, what is likely to happen? I think two things. Number one, maybe three. Number one, there is going to be a lot of lawsuits, and I think UBS is. We know that the UBS share price is not does not reflect such a bargain deal, where essentially the Swiss government is paying UBS and guaranteeing a lot of debt in order for it to take over a very large competitor. Normally, the share price should rise a lot. It's not doing so great. I think people understand that there is going to be a lot of lawsuits against UBS, and so even though the government can guarantee the loans, they can't guarantee other liabilities, legal ones. So that's maybe one thing. Another thing is that I think more banks in Europe will fail. From what I understand is that additional Tier 1 capital was introduced to help deleverage these deleverage big European banks who are highly leveraged, and obviously this is always a very risky tier. It was always intended to be very risky, but it was always understood that the shareholders would take the biggest hit. They are the first ones that will be written down in a bail-in, not the additional Tier 1. So, but if this has changed in practice, even though it's against the rules, then these additional Tier 1 bonds, this market probably won't be viable going into the future. So more banks will have more liquidity problems. And I think this actually also should worry other bondholders and other unsecured holders of unsecured bonds, because if the AT1 market doesn't work, they are those next ones in line in the bail-in schemes. So I think going into the next months, I think next month, not necessarily years, there will be a lot more banks in Europe, the big ones, the troublesome ones, the Deutsche Bank, the Société Générale, the RBS. They are going to experience some problem, liquidity problems, and I would not be surprised that these banks will also need to be bailed out by the government. And I think that's so more banks will fail. And lastly, I think this one is a little bit outside the scope, but I think again, it casts a very negative light on the Western financial system, at least European banking system. Very negative light, because they have very clearly stated rules that right. So like equity is the number one in this liability cascade. How come that the shareholders receive new shares, but the AT1 holders don't? Right? It should be AT1. It should be that the equity tier 1, they should be written down. They should receive 0, while the AT1 holders should have shares converted. Right? They should. That's basically what the rule says. But this is reversed, and it's very. I think it's really casts a very negative light on the credibility of the Western, especially European banking system. They have this Basel III rules, but they don't follow these rules. The first, in fact, it came in. It came in power just months ago, and already they have broken the rules. They are showing the world that the rules mean nothing. It's just there to show that they have some very high standards, but they don't necessarily follow. One last comment, and this is again a very much a side comment, is that if you have read, I read on Zero Hedge yesterday an article given in which there is a slide made by Credit Suisse, and in that slide they also talked about this liability cascade. But what's so interesting is that they wrote it in reverse. They made it also. They put deposits in a very light gray, whereas the tier capital, common tier, common equity, CET. CET1, they wrote it deep blue. It's almost like showing people that these common tier 1 capital are the ones that's the last in a bail-in scheme, but actually they wrote it in reverse. They made it such so that I guess to mislead some people who just look at this and see obviously all the bondholders are written off, and the shareholders are made whole. That's just how it should go. That ain't so. All right, that's all I have to say today. Thanks for listening, and visit my website drjlt.com. Thanks.